Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at three strong stocks to consider buying in May ahead of their earnings releases and possibly holding for the long haul. And the three stocks we're looking at today are Arista Networks, Uber, and Shopify. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our Zacks.com/promo page for a look in some of our services, portfolios, and more. All right, so before we jump into the three stocks we're going to look at today, I quickly just want to do a real brief market overview to give a sense of where we are heading into these three companies' earnings reports and maybe why you want to look at the stocks. So the NASDAQ and the S&P 500 closed around 0.3% lower on Wednesday as Wall Street digested Jay Powell's speech and what the Fed might do next. We saw that initial pop right after his speech and the release, and then we fell. After that, the NASDAQ had faced heavy resistance at its 21-day moving average earlier in the week, but now the bulls might have to step in relatively soon, or we could see that fade down possibly to the 200-day moving average. Thankfully, Powell appeared to rule out the possibility of the Fed hiking rates, which people had started to get a little nervous that instead of possibly lowering rates sooner than later, they might hike just amid the lingering inflation. That said, we saw the market pop then the NASDAQ's up about 0.8% as I record this early afternoon on Thursday. So we saw buyers step back up so far based on the idea that at least the Fed's not going to hike, and Powell's leaning a little bit dovish when everyone was worried he was going to be very, very hawkish in his comments. Obviously, the unknowns around the corner, though, might mean that some investors are a little nervous and might want to try to think about timing the market a little bit more and wait for an exact near-term bottom, which is extremely, extremely difficult and can prevent you from cashing in the long haul by just staying on the sidelines for too long. So with that in mind, we're going to take a look at these three stocks to consider buying. They all are on the dip along with the market heading into the earnings releases, and some of them are, one of the stocks, Shopify, is down over 50% still from its all-time highs. So the three stocks we're looking at today certainly might want to consider buying heading into the release. If you want to wait until after the release for maybe a possible further downturn, you can always do that. But these three stocks are worth just as a longer-term investment to put on your radar ahead of their upcoming releases. So the first stock we're looking at is Arista Networks, which trades in the ticker ANET. The company is set to release its Q1 2024 results on Tuesday, May 7th. So the company is a networking infrastructure provider and a leader, in data-driven client-to-cloud networking for large data centers, campus, and routing environments. It has crushed the Zacks tech sector over the last 5 years and the past decade, and it's accumulated over 8,000 plus cloud customers worldwide, including Microsoft and Meta and other huge giants. So right there alone, you know that its offerings are clearly at the cutting edge and very critical when two global technology superpowers are some of its biggest customers. The company is likely to benefit from a software-driven, data-centric approach that helps customers build their cloud architecture and enhance the cloud experience they offer to their clients. The company services 5 total verticals, including what they call cloud titans, customers that deploy more than 1 million servers, cloud specialty providers, service providers, financial services, and the rest of enterprise. It has introduced a new cognitive Wi-Fi software that delivers intelligent application identification, automated troubleshooting, and location services. On top of that, that offering supports video conferencing applications like Google Hangouts, Microsoft Teams, and Zoom, and boosts its wider competitive advantage against some of its rivals. The company's acquisition of Awake Security, which is a network detection response platform that provides autonomous hunting capabilities in response to insider and external threats, has expanded its cognitive campus portfolio with various new efforts. The company's customers include 6 of the largest cloud service providers based on annual revenues. And in 2023, the company's total revenues were $5.86 billion, so nearly $6 billion. And the company's done really impressive growth over the last roughly decade, just outside of a brief 2020 pullback. So in 2021, the company did 27% revenue growth, and then it did 49% revenue growth the year before that, the year after that in 2022, and then it just did 34% revenue growth last year in 2023. Looking ahead, we're calling for a little bit of a slowdown against that booming growth over the last 3 years. We're calling for a 12% revenue growth this year to get up to $6.6 billion, and another 14% revenue growth next year to get all the way up to $7.4 billion. So adding roughly $1 billion to the top line in 2025, even though its growth as a percentage is slower. And then on the bottom line, we're calling for about 8% adjusted earnings growth in 2024, and then 13% adjusted earnings growth in 2025. Overall, the company's earnings estimate revisions are trending in the right direction, and its most accurate / most recent estimates have come in solidly above the current consensus heading into its earnings release, which is always a good sign. And the company has topped our estimates over the last 4 quarters by an average of 13%, including a 22% beat in the fourth quarter. And then overall, if we look at its 2024 consensus estimate, it's up 17% over the last year, with its outlook for 2025 up 31%. So steady improvement recently and over the last year for 2024 and 2025. All of this earnings estimate revision positivity helps it land a Zacks rank #1 strong buy at the moment. And Arista Networks has an industry that's in the top 9% of over 250 Zacks industries. That's the communication components industry. Overall, the stock has been really impressive. It's skyrocketed about 1,800% during the last 10 years to blow away the Zacks tech sector, which is up about 340%. This includes a 230% climb in the past 5 years versus tech's 21%. And the stock's up about 95% in the last year alone. Yet it is down 15% from its March records and trades 12% below its average Zacks price target. So some near-term upside there as well. The stock is currently trying to find some support at its 21-week moving average, as is the wider S&P 500 and the NASDAQ. And it fell from heavily overbought RSI levels on a 10-year time frame to roughly neutral. And then if we look at a closer time frame, it's now also trying to find some buyers and get back up above its 21-day moving average after it fell from overbought RSI levels to its most oversold level since the October market lows. And so it's now trending back in the right direction. And it's currently trading at a 65% discount to its 10-year highs and right near its median at 36.4 times forward 12-month earnings. And it's also trading at a 45% discount to its 3-year highs in terms of its valuation. So despite the fact that it's been on such an impressive run and crushed tech, it's trading at a 65% discount to its 10-year highs and 45% below its 3-year highs, even though it's only trading around 15% below its price from March, those records back then. So overall, Arista Networks has a really stellar balance sheet, and the stock was up about 2% as I record this on Thursday afternoon. So if it is able to impress Wall Street next week, we could see that near-term breakout back above its 21-day and 21-week moving averages. And overall, it seems like a good, solid long-term buy and hold candidate in the broader tech space. And now we're going to move on to Uber Technologies, which trades in the ticker UBER. It is set to report its Q1 2024 financial results on Wednesday, May 8th. So overall, Uber has been a stock that's been on my radar since it went public. It's a company I'm very familiar with. I use it a lot. So 2023 was a really big year for the stock. It posted its first full year profit as a public company in 2023 by expanding its ride-hailing and delivery businesses while streamlining its operations at really every turn. This came after Uber posted its first ever quarterly operating profit in the second quarter of last year. And Wall Street rewarded Uber by sending the stock to new all-time highs back in February. Luckily, though, for investors who missed that run, its shares have cooled off to trade at relatively attractive levels. And it's nice just to see the company has a strong outlook in a segment of the economy that really it transformed from kind of a niche app in select cities to a potentially $50 billion a year behemoth. So we'll dive into a little bit of the transformational 2023 and then look ahead to see what's next. So it posted fourth quarter profit of $1.4 billion, and then the ride-hailing firm reported $652 million in income from operations versus a loss of $142 million in the fourth quarter of 2022. On top of that, its free cash flow hit $768 million versus negative cash flow of $300 million in the final quarter of 2022. So Overall, it was a really pivotal year for 2023. The company's CEO called it a, quote, inflection point, proving that Uber can continue to generate strong, profitable growth at scale. So Uber spent the last several years cutting jobs, streamlining its operations, and pivoting just towards profitability at all turns amid what's been a pretty wild ride for its ride-hailing business and delivery. COVID kind of saw the ride-hailing business go relatively dormant while food delivery soared. And the strength of its core mobility and delivery segments are offsetting the struggles of its smaller freight unit. And its results over the last few years highlight that people are back to living their full pre-pandemic lives and more, where they're using Uber a ton, going out and everywhere. But this hasn't stopped the delivery business. So the delivery business is booming and the ride-hailing business is booming as well. And those two core segments are especially popular with higher income consumers that are less impacted, say, by lingering inflation in various economic cycles, which bodes well for the company going forward and in the near term as inflation continues to hurt a lot of lower income consumers. Uber grew its monthly active platform consumers by 15% in the fourth quarter to 150 million. And it's now focused heavily on disciplined spending and cost-cutting measures, as we said. It's offering fewer incentives to drivers these days and fewer discounts to customers. And it's reducing delivery errors and becoming more efficient while boosting its market share versus its rival Lyft. It's also rolling out more advertisements across its Uber app and Uber Eats to help monetize that growing customer base. It's also heavily scaled back on its in-house autonomous vehicle dreams in favor of strategic partnerships with Waymo for its self-driving ride-hailing. And then in December, the company announced a partnership with autonomous trucking firm and a subsidiary of a large truck firm. It's called Torque Robotics. So that's just they're still focused on this possibility of like a robo taxi future without having to invest heavily on that in-house. It's prepared to compete alongside or possibly with the likes of Tesla and others in that autonomous ride-hailing, delivery, and freight space down the road. So looking ahead to some of its near-term growth, we're calling for another 16% revenue growth in 2024 and 2025. And this came on top of 17% growth in 2023, which came after a huge stretch of booming growth in 2022 and 2021. So it did 83% growth in 2022 and 56% growth in 2021. And now the company's set to do 3 years straight of essentially 16 to 17% revenue growth to get all the way up to $50 billion next year. And then if we look just a pre-COVID period of 2019, it did $13 billion in revenue. So from $13 billion in pre-COVID 2019 to expected $50.5 billion in 2025. It's an impressive jump for Uber. Its total gross bookings are expected to surge about 19% in 2024, with its monthly active platform consumers expected to climb another 13% to about 169 billion. The company already swung from an adjusted loss of $4.65 a share in 2022 to positive 87 cents last year. And now we're calling for 40% adjusted earnings growth in 2024 and then 67% in 2025. And it's crushed our estimates recently, including a 340% beat in Q4. And overall, its earnings revisions have trended heavily higher over the last year. And recently, this helps it land a Zacks ranked number one strong buy. The stock has soared around 80% of last year, including a 45% run in the last 6 months to help it break above its 2021 highs to a record around $82 in mid-February. The stock's now up about 65% in the last 5 years versus Lyft's 70% downturn. That said, as I mentioned up top, it did pull back from its highs. It's trading around 15% below its records and 23% below its average Zacks price target. It's currently trying to find support at its 21-week moving average, as are a lot of companies at the moment. And it fell from its most overbought RSI levels in February to neutral on a historic time frame, and it hit its most oversold level since the market bottomed back in October on a 1-year timeline. So certainly far less overheated than it was several months ago, as is the wider market. Valuation-wise, it's trading at a 50% discount to its highs at 3.2 times forward 12-month sales and 30% below the Zacks tech sector. And its PEG ratio, which factors in longer-term earnings growth, sits at 0.9 versus tech's 1.8. So that shows that its dedication to growing its bottom line in the future. Some investors might want to wait until after they report on May 8th, as we mentioned, if you want to try to play that market timing game. But if you're not interested in that and it's already pulled back so much, it might be worth just diving into Uber at the moment. It was up about 1.5% as I record this on Thursday afternoon. And now we're going to look at the last of these three stocks to consider buying ahead of their earnings releases, and that is Shopify, which trades in the ticker SHOP. So Shop, they report their Q1 2024 results on Wednesday, May 8th as well. So Shopify was one of the standout former COVID high flyers that then got crushed amid slowing growth and higher interest rates. Things are turning around for the e-commerce firm, and it appears worth consideration at the moment. Plus, unlike a lot of these tech stocks that have made new highs over the last several months, Shopify is still trading 55% below its all-time highs from 2021. So let's dive into a little bit of what the company does and then look ahead to what might be next. It provides what it's dubbed essential internet infrastructure for commerce. And Shopify grew in the e-commerce world by focusing on the seller heavily. So its business clients that sell their various things on the internet to consumers, while Amazon really only cares about the consumer. If you read anything about how they treat the businesses that work with Amazon, they don't care about you at all. They say, if you don't want to work with us, go somewhere else. So Shopify has been able to stand out in that world of booming e-commerce by focusing on the seller, while Amazon just tries to get the consumer the lowest price and deliver it as quickly as possible. Overall, Shopify helps companies with everything from site design and marketing to payments and shipping and more. The firm makes money from recurring subscription fees and then various add-ons and then payment processing as well. Shopify grew its revenue by an average of 65% between FY17, so fiscal 2017 to 2021, as everyone went on the internet as quickly as they possible to get that e-commerce presence. It posted even higher growth before that, but its days of massive 60% growth are over, and that is why the stock got hit along with higher interest rates. Those were just unsustainable figures, though, obviously, in the long run. Shopify made up for that slowing expansion by raising its prices for the first time in over a decade in 2023. And then on top of that, like many companies in the space, from Amazon to Uber, as we just mentioned, they're focused finally on the bottom line over just breakneck growth. So the company did 21% revenue growth in 2022 and then 26% revenue growth last year to go from $5.6 billion in 2022 to about $7.1 billion in 2023. And we're calling for another 21% growth this year and then another 20% growth next year to get all the way up to over $10 billion. So massive growth, even though it's not that 60% clip that it was doing before the COVID boom. And then on the bottom line, we're calling for 30% adjusted earnings growth and then another 33% adjusted earnings growth next year as that bottom line pivot pays off. Overall, the company's earnings estimate revisions have been neutral over the last several months, yet its most accurate estimates for 2024 and 2025 are coming in solidly above consensus, and it's crushed our estimates over the last 4 quarters. And then if we look over the last year, its earnings revisions have skyrocketed. So a year ago, we were calling for 10 cents per share for 2024 earnings, and now we're calling for 58 cents per share. So a massive jump there. And then for 2025, we've seen an 167% jump in earnings expectations from 33 cents per share all the way up to 89 cents per share. So that bottom line pivot is certainly paying off in the near term. Shopify stock, though, is still down 57% from its November 2021 highs, even though it's soared about 165% off its lows. The stock's up about 17% in the last 6 months, including another 20% drop from its late February point, where it was the high over the last year. And the stock's still up about 2,500% over the lifetime since it went public. So it's just still trading 55% below its highs and 20% below its recent 52-week highs. It's currently trying to get back above its 21-day moving average. And then if we look longer term, it's currently trading just below its 21-week moving average as well. And like all of the stocks that I've talked about so far today, as I record this on Thursday afternoon, the stock was up over 2%. The valuation levels are still what's holding the stock back. That's certainly why it's not been able to bounce back when most of the beaten down tech stocks are at new highs, or at least close to that. Its valuation levels are just out of this world. It's trading at 9.9 times forward sales versus tech's 4.6. Its forward earnings ratio is even higher. I think it was 100 times forward earnings when the last time I looked. So they're going to have to continue to prove that they can grow that bottom line, which the most recent estimates show that they're trying to. Its balance sheet is really stellar, though. It has about $5 billion in cash and equivalents, $11.2 billion in total assets versus $900 million in current liabilities and $2.2 billion in total liabilities. So great company that's operating a strong business. It's just now got to prove that it's able to really boost that bottom line in order for Wall Street to get back in on the stock. So this is another name that if you want to play it for a post-earnings pop, it's always risky, but it's certainly, if you can handle the possibility that it doesn't fully recover, it's still beaten down heavily. So as Wall Street might pull back from some of these names and take profits as more companies start to report that had reached new highs, Shopify is a name that still has a ton of long-term upside compared to where it was trading in late 2021. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.